Welcome everybody to this week's edition of Reverse Mortgage Weekly, where we go over all the questions that you might have about a reverse mortgage and try to answer as many questions as you can about the reverse mortgage program. I'm your host. My name is Zach Smith. I own Chariot Financial. I'm a Leo. I like long walks on the beach. I'm just kidding. It's springtime and I've got spring fever. What can I say? It's almost 80 degrees here in Colorado today, and boy, it is sunny. I had it like that. So that's my promise to you that we will do more of these in a park setting. Not that that does you any good, but anyways, welcome. We talk about the reverse mortgage for a good half hour, 25 minutes every single Wednesday, 2 o'clock Mountain Time, 3 o'clock Central Time. And really the goal for this presentation is to dispel some of the myths about the reverse mortgage and really just to educate people on this program, because a lot of people really don't know how it works and how it can benefit people. So what are we going to go over today? Let's go ahead and once again, this is me. This is Zach Smith. Again, I am a reverse mortgage planner. I own Chariot Financial. I, like many, have been in the mortgage industry for many years, and I started my own business in 2019. It's the best thing I ever did. So what are we going to go over in this presentation? Well, number one, who typical clients that we see for a reverse mortgage, what a reverse mortgage is, what a reverse mortgage is not, why are people choosing a reverse mortgage, and lastly, how do they work in simple terms? So who are typical clients that we see? Well, we see older adults that are looking for an increase in cash flow, older adults that need relief from high monthly mortgage payments and debts like a mortgage loan, credit card debt, or car payments. So these are folks who basically are equity rich and cash poor. So one of the things that happens in retirement is that sometimes we're not making as much as we were while we were working. So we're on fixed incomes, things like Social Security, pensions, things of that nature. And the reverse mortgage really helps with that cash flow situation. And then also retirees, they may own their home free and clear, and they may have a lot of assets in the bank, and they're looking for ways to establish a safety net for unforeseen costs so that they can pass on a higher net worth to their heirs. That's a big misconception that this program is really a program of last resort, but I really look at this program as a financial planning tool. So what a reverse mortgage is. A reverse mortgage is a mortgage loan, just like any other loan. It does have monthly payments. And that's one thing that I don't think my industry does a really good job about doing and explaining, is that there is a monthly payment for a reverse mortgage. It's just that that payment is optional. So if you want to make the payment, you can. If you don't want to make the payment, then you don't have to make it. I know for me personally, it's part of my whole financial plan to run down to the bank as soon as I'm eligible for a reverse mortgage and take one out, because I know the benefits that I've seen in my clients. I know the benefits of having a line of credit, access to equity, to cut down housing in retirement. So me personally, I'm probably the wrong person to ask, because I am drinking the Kool-Aid. I love this program. I've seen it change people's lives. And if you ask me if you should get one or not, it's always going to be yes, yes, yes. And we can go into why. But if you really want to find out about this program, I always encourage people to talk to someone who has one. I think too many people get the bad advice from the wrong people. I mean, you have folks out there who, are so quote unquote financial gurus talking about how this program is just a way to take your house. That is the dumbest idea I've ever heard from a guy making millions of dollars on giving financial advice. I won't mention his name, but it rhymes with Maeve Damsey. So, but that's the thing, is that if that were the case, every single bank would check out. They would check out of this program, because there's no money in taking people's houses for a reverse mortgage and for the bank. It's like 2008, there was a sentiment that, it's a really tough time for people. And, a lot of people were losing their homes. And they basically thought that the bank was there to take their house. That was their concern. The bank doesn't make money on real estate. That is not a good way for the bank to make money. It ties up too much of their capital. They make money on our money. The second you deposit $10 into the bank, what do? They lend 9 of it out. They make money on the interest. So if you go upside down on your property, or they end, or something of that nature, guess who loses in that scenario? The bank. Every single time the bank will lose in that scenario if you go upside down on your property, or if they have to take your house. So the sentiment, and when I say take the house, what I'm saying is that if you are upside down on the property and your heirs do not want to purchase the home back, keep in mind the heirs can purchase. Let's say that you permanently leave the property, whether you pass, you go into a facility, or you decide to heck with this, I'm going to Panama to live the rest of my retirement. Or I heard Italy selling properties for $1 now, as long as you renovate it in the first 6 months. So, people, as long as it's no longer your primary residence. And let's say that you are upside down on the property. Well, at that point, if your family or your heirs do not want to take on the property, it will become a HUD home. But this is the kicker. HUD will sell the property back to your heirs for 95% of the appraised value. So if you are upside down, number one, the bank loses. Number two, your heirs could purchase the property back if they basically paid 95% of the current appraised value. So again, the sentiment that if for some reason you go upside down, that you lose, no, the bank loses in that situation. Because, another thing I bring up, and I bring this up often because I feel like the best way to explain this program is through stories. And, this gal, I was talking to a gal, I said, I'm a reverse mortgage planner, I'm out networking, as a business owner, you got to shake a lot of hands and kiss a lot of babies. And try not to reverse those. I try not to shake the babies and kiss the hands. I digress. I said, I'm a reverse mortgage planner. And, I don't like those. My friend had one of those. My friend's parents had one of those. And she only got $7,000 at closing. So the first question I asked her, because she had the sentiment that it takes all your equity right away. And then the first question I asked is, how many payments did they skip? Well, they've had their reverse mortgage. Come to find out, they had their reverse mortgage for about 20 years. Well, if you're making monthly mortgage payments on a 20-year note, keep in mind on an amortized schedule, the deck is stacked against the consumer. In a 30-year fixed loan, you pay 50% of the interest in the first 10 years. So what does that mean? The first payments that you're making on a 30-year fixed loan, well, guess where that's going? Your hard-earned retirement, your hard-earned labor, your cash, it's going right to the bank. That's how the bank makes money, is on amortized schedules. So had this person's parents paid on a mortgage for 20 years, they would have paid about $280,000 over that time. And what would have happened? Well, she probably would have got the daughter would have got $287,000 at closing instead of $7,000. But this is the thing that I would like people to think about, is that during that 20-year period, her parents didn't have to struggle. They didn't have to make a mortgage payment. Well, they did have to make a mortgage payment, but they elected to let that payment go on top of the principal. So they were leveraging their equity for victory. So they lived a very comfortable retirement for 20 years. Because this is the thing, that $280,000 is there. Do you want to take it while your parents are alive, or do you take it after they pass? And she was upset because she couldn't take that $280,000 out of the house when they passed. But it's kind of like that saying, everybody wants to go to heaven, but nobody wants to die. Who was going to pay that $280,000 over that 20 years? Was it the parents? Were the parents going to struggle into their later years, cracking that nut every single month so that they could make sure that their daughter got their $287,000 at closing? or maybe they couldn't afford the mortgage payment. They have to sell the house prematurely. So there's a lot of questions that go into that. Forbes magazine wrote an article a few years back about how our parents could be our biggest financial risk, mainly because, quite frankly, we haven't really figured out how to do healthcare in this country. I'm a little saucy today. I don't know why. I think it's the spring weather, but we haven't figured it out. It's still the number one reason why our brothers, our sisters, our neighbors, the people that we look at on the street, when we're driving, it's still the number one reason they're filing bankruptcy is healthcare costs. So that's one thing that is a high cost. So Forbes wrote this whole article about, your parents could be your biggest financial risk. So in this example, the daughter may have had to pay that $280,000 out of pocket. Yes, she would have got it back at closing, but what's better, to pay it while they're there and in the house, or to not have to pay it at all and shift those funds onto the equity? So that's the thing, is that, the reverse mortgage is a lot like taking a nickel out of your left pocket and putting a dime in your right. And people will tend to focus on the nickel. They focus on taking that nickel out of their left pocket there. So basically, the reverse mortgage is a mortgage loan. It has mortgage payments, but it is not required to make those monthly mortgage payments. And generally, the reverse mortgage does come with a line of credit, cash payout, or a tenured payout over time. So those are things that the reverse mortgage would include many times. So what a reverse mortgage is not. It's not a government takeover of your home. It's not, beside what you hear from a lot of people out there, trusted people who are trusted in their communities, to give them good advice, to give them heart-centered service, to give them the advice that it's a government takeover of your home, or it's a way to make you upside down. Again, the way that they determine the funds for these programs are based on an actuary table, meaning it's based on your age. So a person who is 62 can borrow less than someone who is 82. And it's also based on the current interest rates. Now, why is it based on the current interest rates? Because that's going to determine how quickly the loan balance is going to increase. So what the bank is trying to do is they're taking a very delicate dance of making sure, okay, if we do, because this is the thing, let's say I turn 55 or 62. The second I turn 62, I run down to the bank and get a reverse mortgage. And let's say I have a $300,000 balance on my property. And I say, you know what, I'm 62, I don't want to pay a mortgage payment anymore. And you know what, I shouldn't be paying a mortgage payment anymore. Because if you are paying a mortgage payment after 62, you're either taking it from your income, that bucket, which can sometimes be limited, or you're taking it from your life savings. And the life savings becomes your crown jewel in retirement, mainly because you don't know how long you're going to need it. If I took it out at 62, I could live to 70, I could live to 80, I could live to 90, I could live to 100. I mean, if you're a follower of Joe Dispenza and some of his teachings, you might be living to 180. I know that they're longevity experts. I'm joking about that. But the point is that if I take one out at 62 and God willing, I live to 100, I would have not had to pay that $300,000 balance off for 38 years. So if my mortgage payment's $2,000 a month and I have a $300,000 balance, well, what if I took that $2,000 that I'd normally be making my mortgage payment with and open up a life insurance policy for my kid or for my grandkids, or put it in another vehicle, or just kept it in my pocket? So that's the thing that the bank is risking, is that they don't want to go upside down, because if they go upside down, they're leaving money on the table. So they do a very careful calculation to determine how much people qualify for. So again, it's not a government takeover of your home. They don't want your house. It's not a way to make you upside down, despite what you'll hear from other people. That doesn't make any sense. The bank doesn't win in that scenario. And it's not a payment-free mortgage. There is a monthly payment, It's just that most people elect to have their equity make that payment instead of them making it out of pocket, especially if you take into account that most of those payments on mortgages are going right to interest anyways. So those are three big things to remember about a reverse mortgage. So why are people choosing this financing option in retirement? Well, in my opinion, it's very simple. It's liquidity and long-term financial planning. So let's talk a little bit about home equity. Well, equity is great to have, but unfortunately, it's not liquid. It's a lot like having a glass coffee table right there in the middle of your living room full of cash that you can't get to. So you sit down on the couch, you put your feet up, watching your favorite show, and I'm really getting into that Shogun show right now on FX. It's a beautiful work of art, and I know people think I'm crazy, but I love it. It's a widely celebrated novel by James Clavell. It's really, really good. So anyways, I'm sitting there watching Shogun and got this big coffee table in the middle of my living room, put my feet up. Oh, look at all that cash. Isn't that great? Well, what happens if the car breaks down, or you have medical bills, or you have to take a mandatory withdrawal from your IRA and you get taxed on that? Well, you can't get to that equity when you need it. So really, equity is great to have, but it's just not liquid. So it's not like we can take a picture of our house and go down to the grocery store and hand it over to the cashier and pay our groceries with it. It just doesn't work that way. So why does this matter in retirement? Well, most retirees are on a fixed income or have limited cash flow. I would also add that they need to protect their nest egg. So to pay a mortgage payment out of your life savings just is a recipe for disaster. You need to keep your life savings as liquid as possible in retirement. And most people, they don't want to work if they have a cash flow issue, when they're younger. Well, I just get another job. Well, most people don't want to work into their 60s and into their 70s. And we do see that with our brothers and sisters. We do see it. Folks who are working at the cashier line in their 60s and their 70s. Some by choice, some because they have to. Unforeseen medical expenses can liquidate retirements prematurely. We went over that earlier. So the reverse mortgage really solves the problem of liquidity. The reverse mortgage is designed to help older adults access equity when you need it. So that glass coffee table that you have, it just gives you a little drawer so you can take cash out, or maybe you don't have to pay that mortgage payment out of pocket any longer. You can let the equity pay for it. So it establishes a line of credit. So people love the line of credit because if you need it, you can take the funds out. If you don't need it, you don't have to take the funds out. So it's still there. So it really does act as a financial safety net. They also can convert an existing mortgage payment. Let's say I'm paying that $2,000 payment, and I say, you know what, I'm done paying mortgage payments. I'm going to go ahead and just convert this to a payment optional program. And so those are the two ways that they can really increase the liquidity with the reverse mortgage program. So the reverse mortgage is a financial planning tool. Some Americans are living longer, which creates a lot of concern about running out of retirement assets or the amount that they're going to leave to their heirs. The research of Harold Evensky, Sean Pfeiffer, and John Salter of Texas Tech University published an article about the academic acceptance of the reverse mortgage product as it pertains to the survivability rates of one's assets when using their home equity in their retirement plan. Very few of us want to make plans to die with the most equity in our homes. But a lot of the decisions that clients and financial planners make really do just that. And it doesn't make any sense to me. I've always thought that if passing on a higher net worth was important, then the net worth is important, not so much the equity. And really, that's the question that a lot of people ask themselves when they are using the reverse mortgage as a financial planning tool is, would you rather pass on equity or a higher net worth? 9 times out of 10, when people are bequeathed a home, they sell it. They don't want the house. They want the equity. So, in some cases, they want to keep it as a family home, and they can certainly still do that. So this is just a graph that shows over time, if you use your home equity first in your financial planning, your survivability rate of your assets goes up quite a bit. And this is based on several different studies from several different third parties. And if you want more information about those studies, I'm happy to talk to you about it. So there are different types of reverse mortgages. There's a reverse mortgage that you can take out as a conventional type program. It's not a conventional, it's more of a proprietary program that you have to be 55 years or older to take out. And then the HECMs, which we'll look at here, are the FHA program. So what the heck is a HECM? Well, the term HECM is an acronym for Home Equity Conversion Mortgage. And it's FHA's version of a reverse mortgage program, and really the most common. HECM loans are administered by HUD and come with certain protections for the homeowner. These include non-recourse feature, bank failure security, increased access to funds in the line of credit over time as well. Well, we know this fella. This is old Tom Selleck and his legendary mustache. You know, he was quoted as saying the reverse mortgage loan is just like any other loan. The only difference is how you pay it back. And he couldn't be further from the truth. You know, and why is it called a reverse mortgage? The reverse mortgage is still a mortgage. It has a monthly payment. This payment is optional. And if you choose not to make that payment, then the payment is going to be adding on to the loan. So it's instead of you paying down the balance is going to increase over time. And again, this is a slow process. It's not like the next day you're going to be upside down. If you choose not to make a monthly payment, the balance will grow every month. Taxes and insurance do need to be paid separately. So the two biggest myths that I have found on the reverse mortgage is that, one, you'll be upside down on the home within a few years. You know, usually the way they price these out is you have to live to about 110 to go upside down on these programs. Now, if the market shifts, all bets are off, you know, for better or for worse. If it shifts for the worse, which, you know, I have clients out there waiting for the crash, but I don't think it's coming. The crash should have come already, really. I mean, we're quoting people out in 7% interest rates right now as opposed to 2 and 3%. And we're still increasing in value every single month. There is just screaming demand for housing right now. The Freddie Mac expects 50 million millennials to enter the housing market in the next 10 years. So the demand is there. As we know, if there's high demand and low supply, the prices are going to continue to raise. But let's say a meteor hits the earth tomorrow and all prices go down. Then yeah, you could go upside down faster. But who's on the hook to pay for that? The bank. The bank will be on the hook. So you may be in a situation where you could borrow more against your property than it's even worth. And then let's say your house is worth $200,000 and you have a line of credit that says you can borrow $400,000. Well, you are on an agreement with the Department of Housing and Urban Development, with HUD and FHA, on a reverse mortgage that says you get access to that $400,000. So you could end up taking $400,000 out of a house that's only worth $200,000. And our buddies at HUD are the ones who are going to pay for that. Now, one of the things that people don't like about this program is that there's an upfront mortgage insurance premium. There's no way to sugarcoat it. It's expensive. And it's not a reverse mortgage thing. You know, people look at this program and say, oh, you know, those reverse mortgages are expensive. Well, it's not exactly accurate. Yes, they're expensive, the FHAs are, because it's a 2% charge on the property value. So if you have a $500,000 home, they're going to charge you $10,000 in an upfront mortgage insurance premium. Same thing with all FHAs, though, not just the reverse mortgage. So it's more of a FHA thing than it is a reverse mortgage thing. But that $10,000, what are you getting out of it? This happened and the house does go upside down. They have that insured. And that's what will allow the bank to fund these loans, is that they will insure these loans. So they're in a position where if you go upside down, it's a non-recourse loan. You or your heirs won't be on the hook. And to take it further, your heirs could actually buy the property back for 95% of the appraised value. So let's say the house is worth $200,000 and your heirs want to purchase it, but you owe $400,000 on it. Well, FHA will actually sell the property back to your heirs for $190,000 because the house will appraise for 200. 90%, or I'm sorry, 95% of 200 is 190,000, even though you owe 400 on it. So it's really got a lot of safety features that, again, I don't know that a lot of people are talking about. And again, the second myth that I hear all the time is that you don't own the property anymore, that the bank takes the house, that you don't have title anymore. Couldn't be further from the truth. It really couldn't. And it's really a disservice for people to assume these things without knowing, and I talk to my clients and, I don't want to do, I heard they're going to take the title to my house. Well, who told you that? Well, my uncle down the street, and so I'd be careful about the people you take advice from. That's why, you don't have to take advice from me. I offer it because I care. I really do. I want to be of service. I want to live a purpose-driven life. And I want people to know about this program because I've seen how it's changed so many people's lives. But if you really want to know how it's working out, ask somebody who has one. Talk to them. Independent third party, not part of our organization, just your friend, your buddy who's got one. And then you can find out a little bit more about from them how it works and how it's working out for them ultimately. Well, we're coming up to about half the hour here, so we'll go into the rest of this next week. But once again, my name is Zach Smith, and I own Chariot Financial. You can reach me or schedule an appointment to just want to bounce things off me. I'm happy to help in that capacity as well. You can reach me anytime, 24 hours a day at chariotreverse.com. That's chariotreverse.com, chariotreverse.com. Thank you so much for hanging out with me here on this beautiful Wednesday. Hope you all have a great rest of your day and stay safe, and may blessings rain down on you like 1,000 suns. Thank you very much.